Hey, this is Justin, and I've got Arn Cenedalla with Invest with Spark, and I'm here to get a behind the scenes look at Invest with Spark and Arn's business. And Arn, welcome. Thanks for coming out.
Yeah. Hey, Justin. Thanks for having me on. Looking forward to having a nice chat about real estate. And hopefully, we can provide some useful information to your listeners.
Absolutely. So let's dig into your background. It looks like you've been in this industry in real estate since what, 1978? What got you into starting your company? Can you give us a background on that?
Yeah, so there was no grand plan. I actually got a master's in chemistry from the University of Michigan, but grew up in the San Francisco Bay Area, and my dad had opened a real estate office. And I wanted to return to the San Francisco Bay Area after I completed grad school. So, March 1978, returned to California, went to work for my dad in Menlo Park, California, which is basically next to Palo Alto, where Stanford is, basically on the edge of Silicon Valley. And I was a residential real estate broker for 35 years.
So you
Blessed to
got to know the
be,
market really well.
yeah. And I saw prices X, X during that time. So
Wow.
when I was a kid growing up in the San Francisco Bay Area, Libby Canned Food Company was the biggest employer. And I
Wow.
remember as a kid going down, and my friends and I would go out to the orchards, and the farmers would pay us, I forget what it was, 50 cents a bucket for picking strawberries or apricots or
Wow.
whatever. So back then it was an agricultural thing. And then Silicon Valley happened, and I was
That changed
blessed to
things.
see the whole transformation. And of course, it drove real estate values. And so I was a residential broker for 35 years, started buying single family homes as an investment, both in the San Francisco Bay Area and Austin, Texas. Did that for 35 years. And then about 11 years ago, moved to Greenville, South Carolina. Laura and I were just ready for a little bit different lifestyle, and then transitioned my business to multifamily, formed Spark Investment Group, basically the spring, summer of 2026. So I've been pretty much doing multifamily investing exclusively for the last 6 years.
Wow. Okay. So you must have a pool of investors, and your role in that is what?
Yeah, great question. So basically, now I would be known as a syndication sponsor and operator. And so I have two partners, Dan and Brian, and the
That's
three of
right.
us form what's called the general partnership. We locate multifamily investments to buy. We take care of the day to day operations of the investments. We take care of all the accounting. And so we find investors and we pool their money together to buy larger multifamily properties. So right now we probably have $22 million invested with us. We own about 400 units here in Greenville, South Carolina, which is the only market that we work in. One of my partners, Brian, here lives here like I do. He handles the day to day operations. Our other partners up in Raleigh, Durham, North Carolina, about 4 hours away. And he's kind of the financial accounting underwriting guy. My primary role is to find deals. I'm kind of the hunter, spend a lot of time networking with brokers and other investors, and also raising capital for these deals. So our typical investor invests maybe about $50,000 in each of our deals. Our typical investment, we really like the sub 100 unit multifamily properties, really 30 to 50 unit properties. It's kind of our niche. We don't have to compete with the big investor institutional investors, the hedge funds, and we can sometimes find good opportunities buying these smaller multifamily properties from oftentimes mom and pop operators that have owned the properties for 30 years.
Huh.
And so our typical deal size may be 3, 5, 8, 10 million, and that typically requires a capital raise of between, 1.5 to about $5 million. So that's kind of the territory we play in. We've probably completed 8 syndications to date, and we have maybe 4 or 5 joint ventures. If we find a little bit smaller property, 10 units that's maybe not suitable for syndication, we then move to a joint venture model, and they're all in Greenville County. So I'm kind of acquisitions. Brian is operations, the day-to-day nitty-gritty of collecting the rent, leasing the units, fixing the
He can
toilets.
have it.
He can have it. Yes, yes. And that's one of the great things about multifamily. And I love single family investing. And it's a tried and true way to create greater net worth, income. It's a great way to invest, but it's very hands-on and often time consuming, where what we offer is people the ability to invest in real estate with not having to deal with fixing a toilet or paying the insurance or, whatever, getting the grass cut.
I'm sure it's probably pretty easy to find people that have 50,000 to invest. I mean, that's a sweet
Yeah,
spot. I mean, not easy, but I mean, I'm sure it's like a lot easier than finding people that have 1 and 2 million, to invest.
Yes, and that's a great point, Justin. Uh, Basically, there are 2 types of syndications: 506B, as in boy, and 506C, as in Charlie.
Yeah.
And the 506C syndications are only open to accredited investors. And the definition of an accredited investor is someone who has a net worth of over $1 million, exclusive of their primary residence,
Yeah.
or who has an income of $200,000 a year if a single, 300,000 as a couple. At Spark Investment Group, we primarily do 506B investments where you do not have to be accredited, but we have to develop a relationship with our investor. We have to have conversations about their income, their credit, their past financial investing experience. Doesn't have to be in real estate, but do they own stocks? Do they have a 401k?
Yeah.
Basically, what we're trying to ascertain is, do they have the financial knowledge to really properly evaluate these investments and whether they're suitable for them? They're so-called sophisticated investors. And what we like to do is help sophisticated investors become accredited investors and help them on their path to kind of build wealth through real estate investing. One of the reasons I enjoy the multifamily, between Dan, Brian, and I, we have a team. We have different skill sets. Each of us is outstanding kind of in what we do. And what I found in my life, people are usually good at what they enjoy doing, not so good at what they don't enjoy doing.
Sure.
So we each kind of have these avenues that we have responsibility for and play to our strengths. So the complete team has kind of everything covered, where, yes, I have my skills, but I also have my weaknesses and weak points. So forming a team to go out and buy and operate these assets makes sense.
So if I'm understanding correctly, what type of, so if I wanted to invest with you, Arn, and I've got 50,000, or I want to get in on one of the deals like the one you just mentioned that you guys just closed on. How many units was that? 50, 55?
It was 28 was our last close, and then before, in the middle of the year, we closed on 96 units.
Okay. So for instance, how many investors did you have on that on that last one that you just closed, what was that, 28? So 28 units, and you said it was like 10 or 13 million over, to buy in, or total, and then you had.
Uh, well, that was the 96 units was about 10,000,000, the
Okay,
28 units was about 3,000,000, and
okay,
essentially, to buy a $3,000,000 property, we had to raise about 1,500,000. And
sure.
so, 1,000,001 of that was for the down payment. We go to a bank, get a loan for the difference. The 400,000 left over is our CapEx budget. So we have $400,000 in the bank that we then use to renovate these properties, improve them, and increase rents. So the capital raise on that one was between 1.5, $1.6 million. And our average investment usually turns out to be about 50,000. Our minimum is 25. So we often have a lot of people at 25, but then we also have people that come in 200, 250,000. So on the 28 unit deal, I think we ended up with 27 investors who put in the 1,500,000. And of course, the general partners, Dan, Brian, and I, we also invest our own capital in the deal. And typically we'll put in between 10, 15, 20% of the total. So if the total's 5,000,000, we're typically putting in 2 or 300,000 of our own money. So we're putting our own capital into the deal as well as bringing in capital from other investors.
So is it, I mean, you mentioned quite a few investors there on that deal. Was it easy to find them? I mean, how do you get in touch with these folks?
Yeah, good question. So I've had a long career in real estate in the Bay Area, and so I have an existing database of my residential clients over time.
Okay.
So some of them invest.
If
The
they can
other
afford to
thing
live
that
in the Bay Area,
it's hard to buy rental property in the Bay Area. I mean,
no,
when
no,
I
but I
s-
mean, if they could, if they live there, I mean, I used to live there back in the 90s, and it was expensive back then, and now the new
yes,
mayor, it's probably going to go back up a little bit.
yeah, yeah. And what I say to those folks, most of the wealth in Silicon Valley is
Yeah,
tied to tech stocks.
sure.
So a lot of these folks' wealth is in stocks, often for the companies they work for, right? They get stock option plans, they get bonuses, they get shares of stocks. So I simply say, hey, instead of having 100% of your net worth in stocks and maybe particularly tech stocks, would it make sense to maybe allocate 10 to 20% of your portfolio to real estate? And most people understand owning real estate is good,
Sure. What
but
kind of return do you usually tell them they're going to get? Like
yeah,
10%?
we're usually from purchase to the end of the deal, which is typically 5 to 7 years. They'll get cash flow during the hold period, but overall, they're probably going to get between 15 and 20% annual return. Most of that will come at the end with the sale of the property, but during the hold period, they'll typically get cash flow of 5, 6, 7%. It just kind of depends on the deal.
Sure, sure. But they've got to be able to be in for the long haul to let this thing mature. And then, after the property value, I guess, goes up, is I'm assuming you guys do some, improvements like you discussed. And that kind of gives you a little bit more of an insurance that you're kind of keeping up with the times, and making sure the property values stays up there. So is that what's the biggest challenge? I mean, you've got a network of past clients that you've worked with that have capital from the West Coast. I mean, does that well ever run dry? Are you ever, like, okay, the next deal we have coming up in 2026, we need to raise, another 2 or 3 million, and how are we going to get that if we get a big building? I mean, do you just have tons of people from the 35 years of experience? Is that all, or do they just keep reinvesting with you?
Well, That's a great question. And so, in addition to my past clients back in the Bay Area, I'm very active on social media. I attend a lot of conferences. I'm very active in the Greenville investor community. So I'm always adding investors to my database. I probably have about 400 investors in my database.
When you say your database, are you using like MailChimp or how do you
I
just,
use ActiveCampaign, but MailChimp's okay too, right?
yeah.
So basically, we send them monthly newsletters, and then as
Okay.
we get deals, we send out deal alerts. So a lot of our investors are local. Some are back from California, but honestly, we have them all across the country. And it's just a process of getting in front of them. And we have a high percentage of repeat investors.
Yeah.
So we have investors that have invested in four, five, six of our deals. And it's kind of simple. If you do what you say you're going to do,
That's how
and
business
you
works.
provide distributions and you provide cash flow and you're sending your investors ACH deposits. We pay quarterly. So we pay every quarter, Jan
Okay.
15, April 15, July 15, October 15. Once you've kind of proved yourself and people are willing to reinvest. And so um, we're not a large company. We don't have any designs to build this huge syndication company. We're happy kind of doing two or three deals a year in our market, Greenville County, that we know. We're not going outside this market. So you asked about the biggest challenge. It's not so much raising capital. My biggest challenge is finding deals that make sense.
Yeah.
So it's hard so on any deal we found that we felt was a good deal and made sense to buy, we've been able to raise the capital. But I can tell you it's hard finding a deal that makes sense. And that's why we only do two, three deals a year. So for us, our biggest challenge is finding good properties to buy.
So are you guys noticing an influx like we see here in Richmond where the new construction is just on a nonstop boom? That's the way it's been here. Older buildings got really, I mean, bought up like that back in 2010, right after the housing bubble. And it was like a feeding frenzy. But because of the quality of life, the cost of living here has been, good. People have flocked from the DC area and it's been, on the plus side per capita, people migrating here, but the rental pool is unbelievable. I mean, there are people that I mean, it's sort of like suburban sprawl, from the city outwards into the counties, continuing to the developers, I should say, are continuing to build new construction. But there's really in our area, there's not a lot of what you're doing. I mean, there are, but it's sporadic. A lot of it is new construction here. So it's interesting that your niche is so vibrant in South Carolina, and so that's pretty good. I mean, so the only thing that really keeps you up at night is looking for the next deal and making sure that it's a good one.
Yeah, and you raise an interesting question. The Greenville market, the Greenville economy, the Greenville region has been booming for the last 10 to 20 years. And my stepmom lives in Charlottesville, and I certainly understand the influence of Washington, D.C. and the economic and income growth there. So in Greenville, we've had a rash of new construction too, no
Yeah.
doubt.
Okay.
The other reality is rents the last year or two have been fairly flat across the country. In most regions, I think rents have generally been flat. And I think the new construction is part of that because often with the new buildings, those owners offer 1 month rent free or 2 months rent free
Sure.
to get them occupied.
Sure.
And so there's a short term oversupply of rental housing. And I think most people understand supply and demand. So rents have been soft. But I think the other thing we're seeing is the level of new, and I bet it's the same in your market, the level of new construction is rapidly declining because I think what happened was when the multifamily market was extremely hot, 2018, 2019, 2020, everybody was rushing to build new buildings. Interest rates have raised, so it's a little harder to make the new construction work, and construction costs have gone up. So I think what you'll see across the country is the number of new deliveries will decrease. From what I understand, the number of permits pulled out in 2025 for multifamily compared to 2024 was about down 25%. And I bet next year will be similar. So while there may be a little bit of an oversupply now, I believe over time that will be eaten up, which will then set the stage for increased rents. And kind of what I always say is, do you want to invest in an area where nobody else is investing in? Or do you want to invest in an area where millions and billions of dollars are being poured into the market? I would rather follow the big money because obviously those investors see something good about a particular area, and it could be population growth, it could be job growth. And I think what we also see a lot of the immigration from the bigger metros, particularly in the Northeast to the Southeast, the Sun Belt,
Right.
they're bringing higher incomes,
Yeah.
right? They're
They don't bat
generally
an eye.
higher income, wealthier. So I think it's a net positive. We're in a little bit of a trough, but long term, I think that trend and that migration pattern is going to continue. So I actually like being in some of these secondary, less expensive markets because I think there's a demand for it.
I still can't believe you were able to get 100K per door. I mean, I would jump on that in a heartbeat. I mean, that sounds amazing. So you obviously have a knack for finding good deals.
Well, thank you. So
So
just good work and hard work and networking.
I mean, I've I'll tell you a 2 second, excerpt of my foray into what I saw, a 10-unit building a mile away from my house, and I wanted it so bad. I went and I called a buddy of mine. He's like, "Yeah, we can get a couple of people together, and we'll figure out to do the deal." And he never called me back. And he's a guy I ski with, but he's got his own stuff doing here, construction, and it just kind of fell to the wayside. And I kept trying to reach out, and it seems like it would be a stretch. I mean, I'd have to have connections like you do, because I just don't have those connections to be able to pull it off.
Yeah, I think so. What I tell people is just let people know what you're doing. And like when you go to a dinner party or a cocktail party, invariably the topic of real estate comes up, right?
Doesn't. Yeah.
It's like, hey, did you see what that house sold down the street?
Sure.
People are interested in it. And so what I find, it's not like I go around looking for investors, but more I just share what I'm doing. Like I
Yeah.
might be at a dinner and I go, well, yeah, tomorrow I'm going down to Fountain Inn and I'm going to look at this 20-unit apartment.
Right.
I'm not selling them anything, but
Right.
what I find is the people who are interested will kind of self-identify. Or I'll just say, hey, yeah, we just bought these 13 units over in Greer. And, the person I'm with will say, hey, Arn, look, I really like to invest in real estate, but I don't know how. I don't have the time to kind of
Right.
find it. Hey, let me know next time you find a deal. So I think as you develop, just keep talking to people, let them know what you're doing. And that goes also for the brokers in your community. Just kind of make contact with them, kind of let them know, hey, you're out there, you're interested to buy, and you'll attract the people who you can maybe partner with.
And I mean, are the banks giving you, I mean, the rates are still kind of like not quite coming down. How are you guys doing with that as far as building your private equity and then, having to turn to the banks for the remaining? How's that going?
Yeah, so I'm trying to think. The deal we just closed like mid-December, we ended up at 6% from a
Yeah,
local credit union.
right.
So on the 96 units, we got so-called Freddie Mac Fannie Mae debt,
Okay.
which people are familiar with the single family market,
Yeah.
Freddie Mac Fannie Mae loans. They also
Yeah.
do multifamily.
I didn't know that.
And on that one, we got 5.52.
That's good. I mean, for today.
So at the peak, when we bought a few things 2023, 24, I think we got loans at about 7 and a quarter.
Mhm.
Now I would say we're kind of at 5.5 to
So
6.
that didn't affect you and that didn't stop you guys from investing.
No, what it required was just we put more money down to
Yeah,
kind of make the numbers work.
I see.
And basically what we did in 2023, 2024 was, uh, we bought a lot of new construction. We couldn't come to terms with owners of existing property, but we would approach small builders who had duplexes or townhouses. And of course, they had built them to sell to retail investors. And we kind of know the residential market slowed down. So we would come in and say, hey, we'll buy all 20 of your townhouses
Yeah,
and give us a little bit of a discount. So on those, we paid about 7. On one of them, we've already renegotiated with our lender down to 6.25 because they want to keep our business and they want to earn that interest. So the interest rates have had an impact, but it is what it is. And you just have to deal with what the reality is and go from there. Yeah. Yeah. So, the name of the group is Spark Multifamily Investment Group. The website is Invest with Spark, and we'll hope to acquire 2 or 3 other assets in Greenville County in 2026. So that's kind of the goal. I will appreciate it, Justin.